Okay, good afternoon, everyone. For those of you who don't know me, my name is Jerron Kelley. I'm one of the partners here at Kelley and Grant, PA. We're a full-service real estate law firm located in Boca Raton. We practice in a number of different areas of real estate law. That includes landlord-tenant law, where we file probably 300 or more evictions per month across the state of Florida, and handle a variety of other landlord-tenant type matters for investors, multifamily and non-residential commercial investors across the state. We handle a large volume of title and closing work as well, both residential and commercial, which is what I spend the majority of my time in, managing that department. We also handle real estate litigation, association law, wills, trust, probate, and estates, and also some corporate law as well for investors. So just kind of an idea of our practice areas for those of you who don't already use us for your legal work. Welcome, Kim. Good afternoon. How are you doing?
Very well, thank you, Jerron. I appreciate you having me on the program.
Good, excellent. Well, we're really pleased to have you. We've got a great, awesome guest and a great presentation for everyone today. This is going to be some really great knowledge for those of you who are investors, or if you're realtors or property managers that have investors as clients, and you want to give some added value and some powerful knowledge to them for how they can kind of claw back some money from the IRS and from their taxes and get some accelerated depreciation, cost segregation. Kim's going to walk us through that whole process. I think it's just wonderful, really wonderful information that she's going to present. But before I do that, let me just tell you why we created this webinar. We like to have webinars periodically when I run across topics that I think are really important to our clients who are investors. I've been hearing about accelerated depreciation and cost segregation from our sophisticated clients that we do closings for and landlord-tenant work for and litigation work for. Been hearing about that for some time now, for years. And I'm personally a multifamily investor myself. My wife and I, we own 35, or in about a week we'll own 37 units. And I've never implemented it. I never really personally explored it until a couple months ago. And then I did, and I spoke with Kim and engaged her team to work with us on accelerated depreciation. And we got back about $300,000 from the IRS and tax refunds for this accelerated depreciation. And we can use that money to go and buy more properties with that. It's just a great, just great information that, again, I'm glad you're here to learn this from Kim. And just so you know, there's no direct relationship between Kim and myself, other than the fact that I did engage her for my own personal business. The content we're giving here today, or really Kim's giving here today, is really about her knowledge and engineer tax services and their services, in which you can engage them or not engage them. That's totally up to you. We get no compensation for that. I get no referral fees. So anything that I say regarding their services, that they are really great and they do give great customer service, I get nothing back from that, and there's no reciprocity here. So it's all genuine compliments. So before I let Kim take over, let me just read her bio and let you know who she is and who's speaking to you here today. And then before we dive into, I also just want to mention that you can put questions in the Q&A box there as we go forward in the presentation. I may periodically interrupt Kim with maybe a few pertinent questions that I think she might want to answer, but we want to keep the content flowing. The content's going to last probably about 45 to 50 minutes, estimated time frame, and then from there we'll take some Q&A. Kim and I will remain online here on the webinar for another at least maybe 15 minutes afterwards and answer some of those questions, or hopefully most of the questions that you've asked. And if your question was not answered and we didn't get to it for any reason, I put Kim's contact information as well as my contact information in the chat box there, so you can reach out to Kim directly if your question wasn't answered, or it's a private question that you want a specific answer to. Kim would be happy to help you with that. So Kim Lochridge is the Executive Vice President for Engineered Tax Services, an industry-leading provider of specialty tax services in the United States. Kim possesses a powerful combination of real-world business management skills with a fundamental understanding and practical application of tax codes as they relate to real estate and energy-efficient incentives. This knowledge and experience has positioned her as a big league tax expert for Fortune 500 high net worth individuals, ultra high net worth individuals, single and multiple family offices, architects, engineers, and CPAs worldwide and nationwide. Ms. Lochridge is personally a real estate investor since the late 90s. This activity has earned her a seat on the tax committee for the Washington, D.C. based Real Estate Roundtable Group, where she collaborates with top lawmakers and holds a variety of other board positions. And prior to joining Engineer Tax Services, Ms. Lochridge spent over a quarter of a century in entrepreneurship and had important roles with the accounting, real estate, and energy industry. And Kim is also a frequent multinational speaker in the tax, investment, private wealth, and family office spaces where she altruistically shares her expertise with others. So excellent. Welcome again, Kim, and we're off to the races. Let me turn it over to you.
All right, sounds great. Thanks again, Jerron. I appreciate the invite today, and can second your sentiments about this being very organic. And I'm so happy that we were able to help you with your projects, and I appreciate it as well, the opportunity to speak with everyone. So without further ado, I know that he's already been over a lot of this, so I don't have to reiterate that, and we'll save us a little bit of time to get into the juice. Today you may have heard about cost segregation. You may even know what it is, but I can probably guarantee that those of you on this presentation today is going to hear it like you haven't heard it before. I've been doing this for a very long time. I've learned to be able to articulate this in layman's terms. So there might be some things that you don't quite understand or are a little bit foggy on, and that's something hopefully that I can help clear up today. And we'll talk about kind of what is it, why, how, where, when to use it, and when is it going away and what does it mean? We'll talk about all of that. As a baseline, as most of you probably know, that when we buy a commercial or investment property, we're depreciated under a specific class life. So normally, I'd say 9 times out of 10, a CPA will put the real property on a depreciation schedule for either 27.5, which is multifamily or residential, or 39 years. 39 years is reserved for commercial or short-term rentals. So those of you who are in that short-term rental space, you should be depreciating it over 39 years, which is unfortunate. The reason that the IRS sees it that way and requires the 39-year class life for short-term rentals is because they view it as a transient, which is like a hotel. Hotel is commercial, so they require that we put short-term rentals in a 39-year class life. So there are other assets of depreciation. So personal property, and there's different buckets, different class lives, which are dictated by the IRS. So it's very clear as to what and how and where those belong on the depreciation schedule, depending on the years, of course, the IRS can and has changed that over the course of decades. And so, personal property would be things that are shorter class lives, and we'll review those assets a little bit later in the slides. So, why would anybody do a cost segregation study? And this is something that has been around since the 1940s, believe it or not. I think a lot of people are just learning about it because of bonus depreciation. Bonus depreciation is separate and distinct, and as a result of a cost segregation study. So I think that's important to note because we want to make sure that, people don't think that the bonus depreciation is cost seg, right? So they're two distinct, different things. So when we do depreciation on a depreciation schedule, when you report an investment property, your CPA will put that, as mentioned, as a whole building, right? Either 27.5 or 39 year typically, unless they tell you to go get a cost seg study. When that happens, you're putting the entire purchase price minus land, right? Land is not depreciable, so we'll carve out land and we put the rest of that on a depreciation schedule for those long-term assets. When you do a cost seg study, we're no longer depreciating the entire building as a whole. We're breaking out each of those individual assets into different class lives and different buckets. So we have lighting or electrical, we have mechanical, we have plumbing, we have cabinetry, flooring, finishes, structural, roof, windows, doors, those types of things. When you break it out into different assets, as you see on the right-hand side of the screen, it gives us the ability to then plug those specific assets into one of the faster buckets, like the 3, 5, 7, or 15-year classification. So this is very helpful in depreciation and accelerating. And you're not really accelerating it; you're just reclassifying it. I think there's a little bit of a negative connotation to accelerated depreciation. Really, it's just a reclassification. It's kind of like the difference between, well, let me explain on this slide. So let's pretend, if those of you who understand tax filings, you file a 1040, and there's an option to file a 1040 EZ if your taxes are very easy. I have daughters who are in their 20s and 30s, and my children, are still, my 21-year-old certainly still files a 1040 EZ, right? She's in her senior year in college, and she doesn't really have a lot of income, and so hers is easy. She takes the standard deduction, and she files a 1040 EZ. As we get older and we start having a home and some deductible assets, then we start switching over to filing a 1040, a little bit more complicated, but we're itemizing those deductions. As a result of that, in many cases, we need to get a CPA because the 1040 is quite expensive. Okay, so we spend a little bit more money so that we can get additional deductions using the tax filing of a 1040. Well, cost segregation is exactly the same. So when you are putting it as a whole building approach and you do a straight line depreciation on that 27.5 or 39-year property, you're taking your standard deductions, right? You're just taking that asset, you're dividing it by 27.5 or 39 years, and that goes over the course of that period of time, and it's static. It's just the same depreciation every year, year over year. So this changes things when you can maybe hire a vendor or a cost seg provider to go spend a little bit more money to do your itemized building. That's what a cost segregation is. So we're itemizing the assets instead of depreciating them in whole. Okay. And as a result of that, it gives us a lot of tax benefit, which we'll talk about during these slides. But hopefully that gives you kind of a good foundation as to what cost segregation is compared to not doing a cost segregation. And that, like I said, builds our foundation. So why would we do this? Well, we do as a result of the reclassification, we get accelerated depreciation. Also, I think the most important point on this whole slide is that the IRS writes what's called ATGs, or audit technique guidelines. Those books or manuals are there for IRS agents to be able to audit a return if it encompasses certain things. In this case, if your tax return is under audit and you have a cost seg study, they will refer to the ATG, or the audit technique guideline, their manual of how to audit those. And in that ATG, it's very interesting because the IRS states that the maker's methodology, which is what cost segregation is, not straight line. There's straight line depreciation as one method. Then there's the maker's methodology, which is the, and it's MACRS, just so in case you want to look it up. But the maker's methodology is the preferred method of depreciation by the IRS. And the reason for that is because it's more accurate. So when you're breaking down all the assets in the building, it's more accurate in notating what was there. And in our cost segregation studies, we're the only one in the country that actually includes a condition factor. So when you buy a property that's 20 years old, you're going to have assets. Some of them might be new. Maybe they renovated it right before you bought it, but then the whole rest of the structure is old and maybe 20 years old and is original. So when you do a cost seg study, not only are we breaking down all of the assets, but we're also attaching a condition factor so that we can determine what the age of each of those assets are, so that we can determine the value of that asset, the replacement value. So this makes it much more detailed, and this is why the IRS is listing the maker's methodology as the preferred method of depreciation. So you're going to be more in compliance, right, with that. Also optimizing annual write-offs. So in the future, doing a cost seg study on your baseline or your original purchase, and then as you layer on improvements, renovation, retrofits, or whatever you're doing, additions, you have the ability to refer back to that cost segregation study for, things like repairs and routine maintenance, or the abandonment or retirement of assets during demolition, okay, or renovation. So those are some really good benefits. So this is a report, if it's done right, that you can use year over year, and it will pay you back continually just because you had that original baseline study. Okay, and we'll get into more of the details in the slides. And then the other reason why is bonus depreciation. As I mentioned in the beginning of the slide, bonus depreciation should be distinct and separate in our discussions, but bonus depreciation is a result of cost segregation, especially right now. Bonus depreciation historically has been around since 2006. That might surprise a lot of you because you're probably just now hearing about it from the Tax Cuts and Jobs Act in 2017. And that's because in the 2017 Tax Cuts and Jobs Act, there was an enhancement and an enhancement and expansion of the bonus depreciation, which made it much more lucrative for just about everyone who owns real estate. And we're going to get into the bonus depreciation. Hopefully I won't sound too much like an infomercial, that it's coming, but I promise it's coming. And I'll share with you that information.
One question, we haven't been asked this, but it's actually a question I've heard before that my clients have asked. If, let's say, someone's purchasing an investment property, and let's say they're going to do a project to get that stabilized and get all the units fixed up, and let's say it's something easy like a quadplex, and they're going to go terminate the whether they terminate the leases of the or the month-to-month tenancies of the tenants or not, or they do the or do it over a period of time. Let's just say hypothetically it's a 6-month project, and they're going to go spend a couple $100,000 in improvements. Do you recommend that they start the study right away, right after they purchase the property, or wait till after that project is completed to do that?
Yeah, thank you for that question, because it's a phenomenal question. And had I wanted you to plant a question, that would be one that I would want you to plant.
We didn't discuss this beforehand, I can promise
We
that.
didn't plan it. That's a great question. And, if I had my magic wand, I would always want somebody to do a cost study as soon after they buy it as possible, before any renovations. The reason for that is because we are establishing a baseline for that particular property, and we're establishing to the IRS what was in that property at the time of purchase for that amount. As you layer on improvements, those get layered on your depreciation schedule as well, and those are distinct and separate events. And so we want to make sure that if we can, now that doesn't prevent us from being able to go back and do a cost seg study on the original purchase after the improvements are done. We can still do that. But for magic wand, for advice, please get a cost seg study done soon after you close, before you do any renovations.
Just one quick follow-up on that. I won't keep stopping you here, but so let's say you buy the property, they call you the next day or next week and say, Kim, please do the baseline cost seg study. And then they go put the $200,000 in, and it takes 6 months. Should they then call you back after the 6 months to go revise the study, or what's best practice there?
Yeah, good question. And we'll cover that in some of the future slides as well. But, typically my rule of thumb is if your renovations are over 50,000, then it would behoove you, depending upon what improvements you did, you might be able to do another cost seg study, but you don't always have to. And I can make that determination or the evaluation once, you can email me and say, hey, this is my situation. This is what we did. This is how much we spent. There are literally tens of thousands of different buckets there are different assets that we can put into each of those buckets. So a lot of it is going to dictate, man, if you can do that and you get the bonus depreciation 100%, then you probably don't need another study. But if it's all encompassing and there's a lot of different renovations or different types of things that you did, maybe you did it in an addition and then you added a kitchen or you renovated a bathroom, and there's lots of different components to it, that would be different than if you just put in a pool, right? So emailing me and letting me know what you did would be very helpful, and I can help you determine whether you want an after study. So we would call that an improvement study, or an add-on study. Okay, and that would be something different. A lot of people think that we're updating the original cost seg, but we're not. The original cost seg, it reflects the original baseline of what was there in the property. The only update comes in the partial asset disposition, which we're going to talk about in later slides.
Perfect. Thank you, Kim.
And just one question due to the bonus depreciation. Moses had a question about the depreciation begins when does it begin for a property converted to rental from personal use? So you have a primary residence that you turn into a rental. We see this a lot. The bonus depreciation is going to trigger on two different dates: the original purchase date and the placed in service date, which have to be under bonus depreciation rules, which we're going to talk about years later as well. But that's important because the date that you convert it to a rental, your in-service date is going to be the date. If it's a long-term rental, it's the date that you began marketing it for rental. If it's a short-term rental, it's the date of your first guest. So there's a couple of different nuances there, but that's what the date that you would use for your in-service if it's was converted property or went from a homestead to a rental. So hopefully that answers Moses's question. One of them anyway. So, and then we'll just go along. We'll keep going, and then we can answer more of these questions later. Who's a good candidate for cost segregation? So, essentially any owner of commercial investment property. Anyone's a candidate. A lot of people think, well, can I do a cost seg study if I'm passive investor? And we'll talk about passive versus active just a little bit later. But if you have investment property, it doesn't really matter whether you're passive or active. Now, obviously, if you're an active investor and you have real estate professional status, or you carry that material participation, your deductions and your cost segregation benefits are going to be far greater than if this is just passive. There's some limitations there. So keep that in mind. But really, a cost segregation is for anybody who does that. Now, let me just back up a minute, because normally I say this in the beginning just to kind of earn the right to talk to you. But personally, I am a real estate investor. And I think Jerron mentioned that in the beginning. But, I have, my portfolio consists of, I'm a bit of a deal junkie. So I have about 14 or 15 cannabis warehouses, 800 doors of multifamily, long-term rentals, short-term rentals, about 5 or 6 of them, and also internationally. So I do them here domestically as well as in Mexico. I've got a hostel in Portland, mobile home parks. I love mobile home parks. I also have a gas station. So I have a portfolio of quite a bit of, mixed, triple net lease, throw that in there. And then you have, stuff that, most of those we're managing ourselves. My husband is actually the real estate professional, quit his job a couple of years ago so that we can have that as an active write-off for offsetting my income. And it's been wonderful. So if you guys have questions about real estate professional status, material participation, and how that works, then I'm happy to answer some of those questions for you. If you want to email me. So hopefully that helps give you a little bit of insight as to, not only am I, do cost segs, a cost seg provider, but I do specialty tax, and I really help people organize their financial picture so that it's, being the most tax efficient that they can. So that's kind of where my expertise falls, not just a cost seg provider. There's a lot of those out there, but we find that this relationship is much more of a partnership where we can help long term. And once you're a client, you're always a client, right? You can always reach out and ask questions, and we can review some of your properties. But going back to the slides, any owner of leasehold improvements. So let's say that you own a retail strip mall, and the tenant comes in and spends $100,000 on the improvements. They can be eligible for a cost seg study and take those deductions even if they don't own the building. Okay, so they own the improvements, and so that might be, I don't know how many retail people we have on here, but I just wanted to point that out. Any owner who is paying federal tax or state income tax, which, we believe that everyone should pay tax, but there's nothing in the code that says you have to leave a tip. And so we're in the business of taking that tip off the table. And so anyone who's paying federal or state income tax and they own real estate, this is a fantastic relationship for you, and so that we can help you minimize that. Also, if you're a for-profit entity, obviously, if you're nonprofit, that's going to be a little bit harder because you're not paying tax usually. So for-profit entities, that would be another candidate. Or owners planning to hold an investment property for over a year. If you're only going to hold a property for 2 or 3 years, a lot of times CPAs will tell you don't do a cost seg study because you're just going to give it all back and recapture anyway. Bad advice. I have experiences in multiple arenas where if you're only going to hold a property for 3 years, chances are you're doing some substantial renovations in order to inflate the equity, in order to be able to make it worthwhile to sell that quickly. And if that's the case, a cost segregation is absolutely recommended in that partial asset disposition. And we'll talk about what that is and how that will help you minimize the recapture upon the sale. We can get deeper into those.
And
There's
Kim,
my
I just
quote,
want,
but I'll pause.
yep, Kim, there's been a couple questions about depreciation recapture and the fact that, people believe that you're going to have to pay these amounts back, which may be true in certain scenarios. In other scenarios, it may not be, including if you're 1031ing your money and, you upon your death, you leave this for your children and then it resets the basis, which are we going to get into all that? Because I just want to make sure, kind of give a preview, because there are these concerns. So,
yeah, let's address it now. It's a great time. So the recapture is a real concern, but let me go to another analogy that I have found that helps a lot of people internalize, what this is. If you're going to use cost segregation, and that's it in your real estate portfolio, that's like building a house with only a hammer in your tool belt. Okay. So as you should all know, if you're going to build a house with only a hammer, that house probably isn't going to be very good. And so it's probably going to fall down. So we really need a lot of tools in our tool belt. Cost segregation is one of them. The tools, that we want to be able to use would be things like cost segregation, bonus depreciation, 1031 exchanges. I mean, there's all kinds of tools that you want in your tool belt when you're going to go build this house or this financial picture for yourself. And so those of you who, I'm going to go do a cost seg study and then I'm going to turn the building in 5 years later, and you sell the building and you don't talk to your CPA about what your options are, and then you get caught with recapture and gains and all this stuff you had no idea that you would end up having to pay. That's a problem, right? So your CPA is a tool. Hopefully they're well versed in real estate, and so recapture is real. You want to make sure that you're setting those. We'll talk about bonus depreciation. I keep saying we're going to, but we will talk about bonus depreciation. That's kind of like an advance on a paycheck. Start a job and you're going to say, Mr. Boss, I'm going to come work for you for 5 years, but I want you to pay me 5 years up front. And he's like, great, you can have all 5 years up front. Okay. Now there's some people that are just going to take that 5 years and they're going to blow it. And then they're not going to be able to finish their job because they won't have enough pay. And there's others that are very, very good with their money and strategic, and they're going to turn around and reinvest that money. And then they're going to end up making more than they would have had they just gotten paid every 2 weeks. Bonus depreciation is the same way. If you're going to take bonus depreciation, take an upfront, accelerated depreciation through bonus, you want to have a plan. If you're just going to throw it in a savings account, I probably wouldn't recommend that you spend the money on a cost seg study. You really want to think like an investor and think like, what is this money going to do for me, and how can I use this to put improvements into my property so that I can raise rents and make more money over the course of the 5 or 10 or 20 years that I would have had this anyway. But a couple of different things back on the recapture point. When you take the tax deductions, you're taking the tax deduction at ordinary tax rates, usually the highest tax bracket. When you have recapture, typically you're giving it back at capital gains rates, and those are less. So right off the bat, just by doing this, you have about a 15% arbitrage in your favor. Secondly, there are lots of ways. Like if you were to sell that property and do a 1031 exchange, instead of just pocketing the gain and having to pay the recapture, your recapture gets rolled into the new deal and you don't have to pay it back. So that becomes a very, very powerful tax strategy when you can use that depreciation now, sell the building in 5 years, get a bigger building, but you're rolling in that recapture. You've gotten to take that bonus depreciation up front. This is a lot of CPAs miss
and
this.
Using, I'm sorry to interrupt here, but I plan on using the money that I have to go buy more real estate. So it's a compounding effect. And or I also lend money at private lender rates, somewhere between 10 and 12%. I do some of that on the side. So I can use that money where I'm getting 10 to 12% interest on that, or buying other properties. Why would you not do it? I understand there are some scenarios. If you're a house flipper, you're flipping homes every 6 to 12 months, I get it. It's not for you. This is really not the right product for you. Or if you plan to sell it in 2 or 3 years, or if, again, like you said, you just plan on throwing it in a savings account and watching, 300,000 or 500,000 or whatever it is sit there for years. It's probably not the right program. Although that arbitrage point that you picked up on, well, didn't pick up on, but you explained to us, that's huge as well. You know, I really didn't think about that, but that's also a great point. So.
Yeah. And there's another tool too that we'll talk about where basically you're using the bonus depreciation on the new purchase. As long as this happens in the same tax year, you're using the bonus depreciation on the new purchase to offset the gain and the recapture on the sale. I've actually used that strategy on one of my mobile home parks. It was extremely valuable. So we can talk about that later in the slide as well. But you hit the nail on the head. You know, it's a tool, right? This is a tool. You have to use the tool correctly. If you're going to go use a tool to saw a board in half, it's probably going to be a wreck. Right. So make sure that you're using the proper tools at the proper time in the proper place, and that you have enough tools to do the job, you know, that's at hand. So I can't stress to you enough the importance of don't just use one tool. Okay. Because you need a whole lot of tools. Okay, so moving on, I want to talk about kind of which types of properties would benefit for cost segregation. This could be new construction. We'll just go over these kind of fast. New construction, renovation, existing properties. That means properties that you've already owned on your books for 3 to 5, 10, up to 15 years. Okay, so that's usually my cutoff is 15 years, unless you're using it specifically for a tax strategy, and then we can talk about it older properties. But existing properties, new or recent acquisitions, so purchases, leasehold improvements, as we talked about before. If you're the owner of the improvements that you're putting into a space, we can talk about the cost seg there. Step up in basis. So if there's an inheritance or a partnership buyout and you have a step up in basis to that fair market value, you now have a new amount that is your basis that you're going to want to do a cost seg on. That's a great opportunity. And then that will help save some of the inheritance or the estate tax as well, if there is any. And then 1031 exchanges, right? So anytime you do a 1031 exchange, if you have an excess basis, you can apply cost segregation to the excess basis. And those are all really good opportunities for cost segregation, okay? So I want to get to, I want to get to, you know, I don't really want to delve on in this slide too much, so I'm just going to skip over it, but because I have other examples that are a little bit better. Just one of the examples on this, you know, this is a reclassification summary chart. So, you know, I don't recall what the total purchase price on this property was. I would imagine it might be $3 million, but say it's a multifamily. You know, the depreciation without cost seg, this is your straight line depreciation in column 2. So depreciation without cost seg, essentially, if you buy it halfway through the year, you know, you're going to get your prorated straight line depreciation. And then you can see that static straight line depreciation, 102,000 every year for 27.5 years. Okay. So that's basically what majority of people are doing if they don't do a cost seg. When you do a cost seg, and in this case, this was eligible for 100% bonus depreciation as a comparison. A lot of people think that by taking bonus depreciation, you're accelerating all of your depreciation and therefore you have no depreciation going forward. That is also a myth. Do not fall for that. Do not let anyone convince you that that is the case. And I will prove it to you on this column 3. Bonus depreciation, essentially, by doing this study, they got $1.2 million in tax deductions upfront in year 1, is in comparison to $55,000. Okay, huge benefit there. And then every year after that, they get $70,000. So in this case, you can see yes, they are accelerating a depreciation high, but it's not all of it, certainly not all of it. And in fact, you're taking about a $30,000 hit is all in depreciation, which multiply that by your tax rate, you know, that might be about 10 grand difference. But you got the 1.2 million up front, where you as an investor get to reinvest that. And how much more can you do that? So my analogy to this slide is kind of like, you know, if you scratch a ticket and you won $40,000, you know, do you want $40,000 up front, or do you want $1,000 a year for 40 years? And yes, you might have to take a little bit of a discount on the 40,000 if you take it up front, but the benefit to having that 40,000 up front is very beneficial, because then I can turn around and do improvements on my property and raise rents. If I got $1,000 a year, which is what we're talking about here, right? You're getting that extra $30,000 a year by straight line depreciation. That $1,000 a year is going to buy me groceries, right? I'm literally going to eat an extra $1,000 a year. So it's not going to do me any good for 40 years getting $1,000 a year. There's no power in that. Like, we want the power as investors. So keep that in mind, that this is part of that tax tool.
Yeah, I didn't mean to interrupt. Sorry, Kim, but just said a different way, that $1.2 million, you can buy another $3 or $3.5 million building with that. You could have double the amount of units that are paying your mortgages down on those properties and are appreciating, and you're also getting other depreciation benefits from the second property. I mean, the benefits just compound and compound on each other. It's exciting stuff to me.
Yeah. And, Kendra mentions, the reduction in basis, when you sell, and that's all part of the tools, making sure that you have the right tools in there. Yes, it is going to reduce your basis because you are depreciating that asset. But keep in mind that the reason the IRS allows us to accelerate some of these assets into faster buckets is because those assets are not designed to last any longer than that. Okay, hence the reason why this is the preferred method. Why should we depreciate carpeting or flooring over the course of 27.5 years when we're going to replace it every 5 years? Right? So what we're doing is we're taking the appropriate asset, putting it in an appropriate depreciable bucket, so that when we reinfuse those assets back into the property, we're reinfusing our depreciation too. So yes, you might be reducing the basis, but as you layer on the improvements, you're reinfusing that deduction, and you got the tax deduction. So it's a powerful tool, very, very powerful tool for investors. So thank you for your question, Kendra. I appreciate that. And then, so let's move on, and I just want to make sure we have enough time for additional questions. This is just the detailed engineering of how we break it down. Of course, these assets are 39 years, and you'll see in our reports they'll be 5 and 15 years as well. But this is the structural part of it, and this is the detail that we get in our engineering reports, which is very important because we're establishing the asset of each component. You can see that we're not just calling it a roof. We're calling it, down here in the woods, plastic, and components area, we're calling it the roof, the interior partitions. There's all kinds of things, the construction, the thermal protection. There's all kinds of different layers to a roof. You can't just call it a roof, because if you're going to replace a roof, you're not taking out the construction, the wood framing. You're actually taking out just the top 2 layers. So you want to have a cost seg study that's going to break down those assets for you accurately, so that you can take that partial asset disposition in future years. Partial asset disposition, I keep saying it, but the definition of it is a partial asset disposition is just that. It's removing of part of your asset. So if you have an asset, 5 years later, you put on a new roof, you had a roof. You're depreciating that roof by law over 27.5 or 39 years. When you bring in a new roof that is 5 years later, you have to reinfuse and you have to capitalize that roof again at 27.5 or 39 years. The problem with that methodology, now you're depreciating 2 roofs, one of which doesn't even exist. Why should you want to continue to depreciate that first roof when it's not even there? So partial asset disposition, you can do as a result of cost seg. You have your baseline set like we talked about. Then when you put the new roof on, you go into the cost seg, you remove the remaining depreciation of the old roof, take an immediate deduction. Even though you have to capitalize the roof, you're taking a deduction from removing the old roof. Okay. Hugely beneficial for short-term holds, 3 years when you're doing a lot of renovations. Get that partial asset disposition off your books and reduce that recapture when you sell. Okay, huge tool. This is probably the #1 tool that I will find that most people don't utilize and don't use, and it'll probably be a good takeaway for everyone on the call. Partial asset disposition. If you want to learn more about that, you can go to our website under services and cost segregation. There's a blip on partial asset disposition. So these are just some of the results that we get in this particular property. Say $1 million purchase, we've got, obviously we took out some land, so $1 million basis, 5-year property, we've got 27% reshifted, 11% in 15-year, and then the rest of it, here's your straight line that stays there. That's your 70,000 going forward, right, on the last example. So that's just a quick one. So we did talk about partial asset disposition, but going to more detail of that, when the ownership asset is transferred or when the asset is permanently withdrawn from use, is when the asset has partial asset disposition capability. If you bought a property that was used, it was 20 years old and you bought it, it's new to you, and you put it on your depreciation schedules, your CPA will not be able to tell you what your roof is worth. They're not an engineer. That's not what they do. Okay. That's why a lot of the tax preparers, either don't have a resource for this or don't push this because they don't have that. We are an engineering firm with a heavy tax background. We go in and dissect that building and give you the amounts of every asset. So when those assets are then withdrawn from use, either by selling it, exchanging it, retiring it, physically abandoning it, or destroying it, or scrapping it, or moving it to supplies, which is rare. But when this happens, you have the ability to go back and take partial asset disposition. Okay, powerful, powerful tool. Layer that on with bonus depreciation. Poof, let me tell you, it's amazing. So let's talk about bonus depreciation. I've been promising this is probably our most important discussion of the day. And I know we want to still do some questions, so I want to get through this pretty quick. Bonus depreciation. Okay, so as we talk about shifting, remember in that slide where I said you had 24% goes into 5-year and 11% goes into 15-year. Okay, that means that the 5-year asset gets depreciated over 5 years. The 15-year asset gets depreciated over 15 years. The rest of it gets depreciated over 39. Okay, so those are the buckets that get depreciated over the course of time. Bonus depreciation applies to any class life less than 20 years. So bonus depreciation would apply for the 5-year asset, and it would apply to the 15 because both of those are under 20 years. Okay. Bonus depreciation comes in, kicks in, and depending on the level, depending on the year that you buy it and the level of bonus you're eligible for, the IRS says, you know what, you don't have to wait 5 or 15 years for it. You get the depreciation all right now. So in that situation where the 1.2 million, okay, was up there at the top, that's because they qualified for 100% bonus. That means 100%. Those amounts in the middle that you see on the basis, the 239,000 plus the 116,000, 300 and what is that? $50,000 basically, $355,000. You get to take that as a tax deduction in year 1, even if you bought it on December 31st of that tax year. Powerful, powerful tool for investors. Okay. So this, you cannot get more powerful right now. I will share personally that because of bonus depreciation that came out on purchased property in 2017, I have literally multiplied my net worth 5 times just since 2017 with this strategy and using real estate. Okay. So I am example of this working the way that I say it works. Okay. So bonus depreciation is on a sunset. So from properties that were placed in service and or purchased after the September 27th date in 2017 through the end of December 31st of 2022. That time frame, you have 100% bonus depreciation, which means that anything we reclassify in cost seg gets depreciated and accelerated into year 1. Okay, that's the bonus. If you purchase it in 2023, that bonus depreciation is at 80%, meaning 80% comes in year 1, the 20% gets reallocated across the 5 and 15-year buckets. So that's how that works. Okay, so it just starts to dwindle. You're not losing any benefit. Okay, it's the same money. You're just how much are you getting now versus how much over the 5 and 15 year. Either way, even if your bonus depreciation is 0, a cost seg study is still beneficial because again, you're shifting those assets into faster buckets, which is more in line with what that asset's life is. Okay. We don't really need to get too much into 1031 exchange because I do want to make sure that we're answering the questions. But as far as 1031 exchanges, there is the strategy that I explained to you that in lieu, let's say you fall out of a 1031 exchange, you don't meet the 45-day requirement, or you don't close in 6 months, and so you're now ineligible for a 1031 exchange. All is not lost. You can use an additional alternative strategy that I was explaining about earlier, where you purchase and sell the property in the same year. You cannot do it in 2 different tax years. That's the only caveat here. But using this strategy, you can sell the property, pocket the cash, buy another property in the same year, do a cost seg study, eligible for bonus depreciation. The bonus depreciation will reconcile with the gain on the same tax year, and your bonus depreciation now covers your gain and your recapture. And basically, you don't pay any more money out of pocket, even though you did the cost seg and got the bonus depreciation 2 years ago. Okay, so it kind of works very, very similar to a 1031 exchange, except in a 1031 exchange, you have to reduce your basis from the gain that you brought in. So if you're buying a $5 million property and you have $2 million that you're bringing in gain, your new basis for depreciation is only 3 million, not 6 million. But if you do this strategy, you still get to keep all the depreciation. You're just using it to offset. And then you don't have to kick the can down the road and pay that tax liability later. You are square with the IRS using your bonus. It's a great tool, amazing tool. But we won't get too much into that anymore. I want to go to a question and answer those for you all, because I know we have about 12 minutes left.
Kim, before we get into Q&A, I feel like we only did a cursory coverage of the 1031s, which is fine. But if we could do another summary of that, the long-term strategy, which is probably going to be my strategy and with my units, is that over time, I'm going to want to take, some of my smaller properties, my triplexes, my quadplexes, and then roll those into bigger properties with a 1031 exchange. Take the gains from that. Let's say I held it for 4 years or 6 years. Sell let's say the quadplex, make a $400,000 profit. Roll those profits using a 1031 exchange, where we're identifying a new property within the 45-day time frame, closing on it within 60 days. Not paying taxes on, let's say, that $400,000 gain, and also transferring all of my bonus depreciation and all the depreciation over to the new property, correct? Do I have that right?
Correct.
That's the first step, right? And then from there, let's say I do that a couple more times over the next 20, 25 years, and that quadplex turns into a 12plex, and the 12 units turns into 30 units. And maybe that, that's just one property turning into, multiplying that 5x times, never paying back that depreciation and never paying taxes during that period of time. Let's say, knock on wood, I've got another 30, 40 years here on earth. I die, leave the properties using a proper estate planning to my children. And right now, as it stands under the code, correct me if I'm wrong, IRS code, my children, let's assuming my wife passes first, I leave it to her, then my wife passes, then that amount is all reset, correct? So meaning my children wouldn't have to pay back that depreciation. Is that how I understand it?
Correct.
Okay. So let's put it this way. I'm just replicating a strategy that I've seen my clients who are worth tens of millions, hundreds of millions of dollars. They have hundreds of millions or even $1 billion+ in real estate. I have several of those clients. I'm just replicating the strategies that they are doing with high-powered accountants and tax attorneys and awesome people like him. So,
yeah, guys, love him, hate him. Trump enacted the Tax Cuts and Jobs Act. He's a real estate guy. Okay, so this was a gift from a real estate president. If you're in real estate, this will benefit you, and it was designed to do so. So you remember all the hoopla about Trump's never paid a dime in taxes? That's because he's a real estate guy and because he does new construction and he utilizes the cost segregation. And when he said, I didn't pay tax because I'm smart or I have smart people on my team, I'm just saying that these strategies are what the wealthy use. And I'm living proof of that. And I will go back to my quote. I believe everyone should pay tax, but there's nothing in the code that says you have to leave a tip. These are legal strategies. Cost segregation is not new. This has been around since the 1940s. If you're in real estate and you're not incorporating some sort of accelerated depreciation or reclassification of depreciation through cost segregation, you are missing the boat and you're leaving a tip on the table. I don't care if you're passive. I don't care if you're active. I don't care if this is, it doesn't even matter. Even if you have losses right now, say you set up the property, you have losses from the purchase, but likely you wouldn't be in business if you're not going to make money on that property, right? We're all pretty decent investors. We know what our intent is. Eventually we're going to make this. And most of the time, the rents and the income from that property exceed what your straight line depreciation is going to be. So why not incorporate a cost seg? Even if you take a big tax deduction now, if you can't use all of the depreciation, most people can't. When they take a $1.2 million tax deduction, they can't utilize it all in 1 year. Most of my investors spread that loss over 2 to 5 years. So if you can't use it all, it just rolls over to next year. So if you have lots of losses or you did improvements this year, oh, I don't really need cost seg. Wrong. Go do it, get it banked on your depreciation schedule in the year that you can and you're eligible to take it. Whatever you don't use just rolls over to next year. You offset your gains and your income from that year. Whatever you don't use rolls on to next year. It's called a passive carry forward or an active carry forward loss, which means that you can utilize it in future years. Now, as that property becomes more stabilized and you've increased the rents as a result of those improvements and that expenditure, now you're getting to the point where, wow, I'm going to start paying tax in year 3. Let's fix that now so that we don't pay tax in year 3. Okay. So keep that money in your pocket. That's the biggest message here.
So grab that bonus depreciation while you can, get it while you can before it's completely phased out. In fact, I'm buying a duplex that cash flow is okay, nothing compared to my prior investments. I'm doing it to get in before 2023. I want to pull that money back out and go use that and be ready for, if let's say prices are shifting a little bit here and there's other great deals on the table in 6 months or a year and a half, I can go in. I bought another foreclosure property right now that I'm flipping, and I can use that money to go make money in other ways. So it's just a no-brainer to me.
Yeah.
But we've got a few other questions here, Kim.
Yeah, Nick has Rick has a good question. Can I take the depreciation amount and use it dollar for dollar to offset income from the sale of a business? The answer is yes, maybe. And the reason yes, maybe is because it really depends on where the real estate income and depreciation rely in proximity to your tax return, whether it's passive or active. If your business was active and your real estate was passive, the answer is no. If you're a real estate professional and you sold a business, maybe you sold a management company, for instance, which is in real estate, then the answer is yes. So it really just depends on kind of how you're structured. And that's something that you would have to dig into with your CPA. Okay. So thank you for the question though. So there's a couple other questions here. It said, in the beginning, Moses has asked, please relate real estate investing rules, etc., using retirement accounts, funds, or mechanisms. And I think what you're talking about is, like if you're investing in real estate within your IRA, maybe, or some sort of retirement account, the depreciation isn't going to benefit you because you're not paying tax within that. So, that's, there's really no use for that within retirement accounts, if that was your question. So Moses, if that's not your question, please restate that so I can answer it appropriately. Emiliano says, don't you pay 25% on recapture? That's higher than my ordinary rate. Well, if your rate is less than 25%, kudos to you. That's great. But most people are paying quite a bit more in tax. I realize there's not a lot of state tax. There's no state tax in Florida, but in other cases you might be paying higher federal tax. So yes, your recapture might be higher. Again, another reason to use your financial planners, your strategists, your CPAs to make sure that you're making the correct decision when you're moving forward with that. And if you've owned, several residential properties for the last 10 years, yes, you can use cost segregation, but let's run some numbers. All I need to run a benefit analysis is like either your depreciation schedules for Emiliano, in this case, where you've owned them for a few years and they're already being depreciated. Send me the depreciation schedules with the addresses. If it's a new purchase and it hasn't yet hit your tax return, send me a settlement statement from the closing and maybe an appraisal to give me a little bit of insight on the property. And then I can run some numbers for you complimentary. Usually that takes me about a day or two, and I can get that back to you with some numbers and see. And then you have some real numbers that you can take to your CPA and say, Mr. CPA, where would this fall into my return? And is it beneficial for me? Can I use this now or in the future? Okay. So thank you for your question, Emiliano.
One thing I'll give you kudos for too, Kim, is your team made this so easy. So many things that I do are like special projects for me, whether it's in my investing life or just projects that I have here with the law firm. And they're daunting, and I don't want to swallow the frog. I knew there'd be benefits to me, but finally I reached out to you. For me, it took maybe, I don't know, something ridiculously simple, maybe 10 or 15 minutes of my time to just connect you with my CPA. He sent you the depreciation schedules. He had a few extra questions that I was passively involved in. And then you did the basic numbers. I thought they looked great. And then not only did you under promise, but you over delivered with regards to the amounts that I got back with the depreciation. I was a little worried that I was heading into something where maybe you would only be able to get me 80% or 90% of what you estimated. It was quite the opposite. You delivered at probably 120% or more of what you estimated. And so it was a really simple process. Don't wait, you all, really, for multiple reasons. Again, the bonus depreciation is phasing out. And then also one other thing is several of my properties I purchased in 2021 and 2022. So I just had my accountant, who I copied here and communicated directly with Kim on the process. He was able to go amend my 2021 and 2022 taxes very easily, super simple. Yeah, I paid a few extra bucks for it, but I mean, the benefits I got out of it were, the costs, the benefits far outweighed the cost. So I just want to point that out. As far as the process is concerned, it's very, very simple when you involve your CPA in it.
Yeah, thanks, Jerron. I appreciate that. And we, in our benefit analysis, we do always try to under promise and over deliver. So usually our estimates are conservative. In fact, some people come back and we lose business because they're like, oh, somebody else promised us, way more than you did. And to be honest with you, it doesn't mean that I can't get that level, but I'm not going to overpromise. And chances are they probably can't meet that promise, and then they'll be disappointed in the end. I would much rather give you a conservative estimate up front and then have you be super happy with me when it's over what I thought it would be, which is 85% of the time, rather than tell you what you're expecting and you're doing all your tax planning based on the number I gave you. And then like, oh, sorry, your project fell short. It didn't really hit the numbers that I thought, So that's not fun for anybody. And so we tend to be fairly conservative. We've been doing this for 22 years. We're based in West Palm Beach, Florida. So we have local engineers. We work all over the country. It doesn't matter where your property is. We have 16 or 20 offices now around the country, and about 50 to 60 engineers that are strategically located. We do an in-person site visit. Okay, this is very important because not all cost segregations are created equal. There's a lot of pop-up companies out there that are doing a DIY or a software based where they don't go out to the property. But I'm sorry, there is no physical possible way, and the IRS knows this, that if you are not in the property with a qualified building professional like an engineer, not an appraiser, not a photographer, but actually somebody who can analyze the age and the condition of those assets, you will not get an accurate report. It will not stand up in the event of an audit, no matter what anyone tells you. They can offer audit defense, but it will not stand up in the event of an audit. So just be aware, buyer beware, please. Don't use those software-based companies. Don't use somebody who's just going to send a photographer just so they can do a property in Virginia when they're located in California. They're trying to cut corners and they're trying to stay relevant in the industry, and you're going to get burned. So just be careful, do it right, and let me know if you have questions. Okay.
Other questions here? Mauricio says, please explain the strategy to avoid minimized capital gain tax. That, as I understand, law allows once in your lifetime. Does it apply to an investor property also?
I think that's the capital gains tax when you sell a home, but I don't think that's a one-time thing. So you might need to elaborate, Mauricio, on what you mean by that. Jerron, do you understand what the question is?
I think a little more elaboration and detail would probably be helpful here, so we know what direction Mauricio is going in. Anila, if you want to answer her question.
Yeah. What if you already sold a property that you held for a few years? Can you go back in time? Once a property is sold, you're not going to want to go back and do a cost seg, okay? Because you've already reconciled all of that. What happens when if you have excess losses? Let's say that you take a cost segregation study and you have excess losses and you're carrying those losses, and then you sell the property. Those passive losses actually convert to active and offset your income. So it's another benefit to doing a cost seg study and having that. But no, I would not suggest, one, because we cannot usually get into the property physically where we have to do a cost seg study in person. We have an engineer go to the site. So once you sell it, you usually don't have access to the property. And number two, once it's sold, you've already reconciled it off of your books. So once it's sold, it's done. So do it before you sell it or right after you buy it. Okay. And then I think we answered that. So Moses came back with the retirement question. What are strategies used to use those funds without it showing as a taxable withdrawal from the retirement account? So Moses, I think you're asking like when you're pulling money out of a retirement account, and then you have a tax liability on the exit of those funds, and then you use the funds to buy a property. Can you do a cost seg study and then offset the tax liability from the removal? I think that might be what you're asking me. If that's the case, I believe that they are sitting in two different buckets. I'm not 100% sure, but you might want to talk to your CPA about that. It depends, if you have passive versus active, but then you have a retirement account, I think they're all different buckets. I'm not sure that you can overlap those without some sort of trigger to remove those lines.
Yeah.
So hopefully that answers.
Yeah, just so Moses, I also own a couple properties in my IRA. I have a self-directed IRA. I bought 2 townhomes with, and they have mortgages. There's a lenders that will lend on that, non-recourse mortgages, but those are not, cost segregation is not going to benefit you for those types of properties if you're talking about within a self-directed IRA. Yeah, maybe speak with your CPA and or speak with whoever, if you are using a self-directed IRA company like mine is New View. I would reach out to them and ask them some of those questions. Yeah. Then I believe Mauricio was saying yes, selling your property. But I think maybe here the issue, and Kim, you can speak to this, is a primary property versus an investment property. This is only used for investment properties, correct?
Correct. Yeah. So only income producing property. Yeah. Okay. And then do you do 1031 exchange, or is it a different company? I actually sit, one of the board positions that I sit on is IPX 1031, nationwide 1031 exchange company. I can put you in touch with them. They're a great company. They do a lot of 1031 exchanges. They're also on the tax committee for the real estate roundtable with me. So a very reputable company. If no plug there, just letting you know that that's who I use.
I also have a really good 1031 company, Emiliano, who can answer your questions. He's a local guy. A lot of my clients use him. He's wonderful, but either way, doesn't matter.
Yeah, go with Jerron's guy.
It really
local, it's nice.
It doesn't matter either way. Happy to give you referrals.
Yeah, great. Okay, I think looks like Moses came back and said that answered his question, so that's good.
Perfect. Glad you did. Glad we answered your question. And Ruben, when you buy a property in a 1031 exchange, remember what that question was, Kim?
Yeah, can you do the cost seg when you buy a property in a 1031 exchange? In relation to 1031 for the replacement property, do you use the reduced basis or the full price to establish depreciation? Yeah, there is a calculation. It's called an 8824. That form is a reconciliation. So it takes the gain from the property that you sold, and then it takes the purchase price of the property you're buying, and it reduces that. So it is reduced, and we start our cost segregation from the reduced price. Because the 1031 is coming in. That's another factor in that whole strategy that I told you about. Don't do the 1031 exchange, use the bonus depreciation to offset the gain. You may find that is actually a better scenario for you in your particular situation, or you may find out that my 1031 exchange is better. So it just depends. So run the numbers is what I would say on both scenarios, because as we have bonus depreciation beginning to sunset, then, obviously the bonus depreciation in the year that you need it isn't going to be as much. So, so yeah, you can do it, and it is based on the reduced price.
Excellent. Well, I think we've reached the end of our questions. Again, anyone, if you have any specific questions about cost segregation, accelerated depreciation, these types of topics, please email Kim. She's wonderful. She's very quick and responsive. Her email address is right here on the slide there, klochridge@engineertaxservices.com, and reach out to her again, any questions. Once I get the recording back, I'm going to blast that out to everyone, including everyone who was on the the webinar here and anyone who registered for it. So you'll have that no later than Monday. Feel free to share that with anyone that you know and have them reach out to Kim with questions. We're also going to be putting this on our, we have a new investor-focused YouTube channel that you can check out. It's Real Deal Investing. You can subscribe to that. We're going to put this on there along with some other awesome content. We've got some great interviews that are on there. I'll go ahead and I'll put a link to that in the chat. But in the meantime, Kim, do you have any other last minute things that you want to tell everyone?
Just the last little bit about the bonus depreciation. There is a bill to do away with the sunsetting. If that passes, then we would still remain 100% bonus depreciation through the end of 2026. So keep your fingers crossed for that. Write to your senators and congressmen and your local representatives and let them know how powerful that is for you and how beneficial. But yeah, that's really all I want to leave you with. And certainly happy to answer any questions if you want to email me. And thank you again, Jerron, so much for having me and for doing this for everybody. I think it's a valuable service and tool that people can use.
Well, it's our pleasure. And again, I put the link to that YouTube channel on there, Real Deal Investing. Feel free to subscribe for more content like this, and we'll be posting this video on there as well shortly. Thanks again, Kim. Have a wonderful day, everyone. And thanks for listening. Take care.